Here's everything you need to know about what Jerome Powell just said at the Washington, D.C. Economic Summit with Dave Rubenstein. The message here was a reiteration of what we got at the FOMC meeting with some small adjustments. And these adjustments are really, really interesting. Before Jerome Powell came out to speak, I actually pulled up this document from Bank of America, and it talked about why it could be that this unemployment report came in so hot for January, that all of a sudden we had so many more jobs, and where did they all come from? And everybody thought that Jerome Powell was going to freak out and have to raise rates substantially and aggressively reposture because of this report that came up. But he actually said something phenomenal that was also pointed out in this report. Jerome Powell talked about this increase in immigration, and it's literally what Bank of America here talked about. Who knows? Maybe Jerome Powell read this report. But this year's update in the increase of civilian non-institutional population of 954,000 was driven almost entirely by an 853,000 person increase in the population of men over 20. While we can't say with absolute certainty, we suspect this increase was driven by a recovery in net international migration. And that's exactly what Jerome Powell actually ended on. Jerome Powell ended on this idea that, hey, maybe one of the reasons we are seeing that companies are having an easier time and there's less pressure for hiring workers is because we are seeing more immigration, because recently immigration data has come up again. That was his quote. Now, at the same time, as he talked about, hey, maybe this jobs report is being explained away basically by immigration, he also, when he was asked, hey, would you change your position of what you said then versus now? And he basically said, hey, well, after the report came out, financial conditions tightened. He basically said, without saying, hey, the market already did my job for me. Remember, the morning of Jerome Powell's talk, and the afternoon of Jerome Powell's talk, the 10-year Treasury yield fell to 3.38%. Think about that. It was under 3.4%, 3.38. Well, after the jobs report and today, look where it sits now, 3.63. In other words, it's up over 25 basis points. It's up 0.25%. And Jerome Powell in this press conference today, even though he didn't directly say it, he said, look, we know things are going to be bumpy. We know the data is going to come out, left, right, center, it's going to come in all over the place. But you have to realize the market has already significantly tightened since that jobs report came out. Those were his words. The market has significantly tightened since then. That's what he said. And when you look at the Goldman Sachs Financial Conditions Index, the same time you saw that jobs report come in is the same time you saw the 10-year Treasury yield jump 25 basis points, is the same time you saw a jump in the Goldman Sachs Financial Conditions Index. You know Jay Powell sits with the Bloomberg terminal in his office, or Refinitiv or Cap IQ or one of these, and he's sitting there studying the markets the same way we are. And he actually explains away this jobs report, not just by suggesting, hey, well, we had more immigration, which is exactly what Bank of America saw, which just reiterates the Bank of America report. But he also explains away the jobs report by saying, we seem to be on the right path, because even though we had something that came in a little bit hotter, guess what happened? Boom, market adjusted instantly. He's like, barely have to do anything, is basically kind of the way he's coming across. So now he does say that, look, it's obviously going to be bumpy. We're going to get some data that comes in strong, some data that comes in weak. That's the way it is. Now, one of the things that I thought was incredibly bullish that he talked about was this idea that a few months ago, probably about 6 months ago, he's like, look, we want the JOLTS spread between, the JOLTS is the measure of job openings and labor turnover survey, and we want that spread to be in line, so basically zero spread. So in other words, if there are 11 million jobs, we want there to be maybe 6 million jobs available, because that would line up with 6 million unemployed people. Right now, we're at almost a ratio of 2 to 1, which is too high. Originally, Jerome Powell wanted to see this go down to 1, but it hasn't gone down to 1. So what did Jerome Powell do? He goes, he gave up on the indicator. It's an indicator. Why did he do that? Well, he finally gave us a rationale for that today. He said today that the difference in the JOLTS spread, which used to sit around 2 million, that is, there were about 2 million more openings than there were unemployed people, that difference is now 5 million. 2.5 times as large. And he says that actually, quote, feels structural. That is actually a bullish statement because it's basically a way of saying, and I hate using this phrase, but it's basically, Jerome Powell used it himself. He basically said, look, this time's just different. The pandemic basically created so many dislocations in the marketplace that people don't really know what they want to do. And so everybody's kind of rejiggering, like, do we like work from home? Do we like in the office more? And all of this rejiggering is creating this disaster in the labor market. And it's one of the reasons we've had the supply chain nightmares that we've had. Now, this morning, we talked in depth about supply chains and how supply chains are substantially loose right now. Goldman Sachs, on a scale of 1 to 10, 1 being the loosest, 10 being the tightest, puts us on a 2 for very, very loose and open supply chains right now. But we still have to see the next 2 factors of inflation come down. Unfortunately, these sectors lag like crazy. Jerome Powell made it very clear, as he's made many a time before, that goods inflation is already coming down. Fantastic. We're already winning on that. Disinflation is present. And he reiterated that that is likely to continue. However, we need to see housing disinflation come in. The problem is that stuff lags a lot. Even Jerome Powell said himself, we don't expect to see the housing disinflation of owners' equivalent rents falling until the second half of the year. Well, I hate to say it, folks, we're barely in the second month of the year. That means we got another 4 months to go before you see that housing disinflation. Number 3, you've got to see services come down, which are heavily driven by wages. They make up 56% of inflation reports. And that 56% is heavily driven by services. But if immigration is helping keep a lid on wage inflation, Jerome Powell does not need to kill the labor market by forcing a recession. As long as inflation goes down and wages stay stable, we don't want wages to go down. We just want wages to be stable. As long as wages are stable, he does not need to destroy people's jobs and livelihoods by crashing the economy. And I think that's why you're getting at least a slightly more bullish Jerome Powell, and you're getting a slightly positive reaction from markets. Markets aren't as jubilant as they were when he started talking, but net, they're higher than where they were when he before he started talking. Now, when he was asked he was asked at least 3 times about, look, how would you change your mind if you had the jobs data beforehand? And he's like, hey, look, you know what? Basically, he says this cycle is different. Okay, so in other words, he kind of suggests, look, it's been explained away. We've got the immigration. The economy or markets are already pricing it in. And he was pretty clear that, look, it seems like we're on the right path. And now the goal is stay the course and let's see what the data brings. And so far, the leading indicators, not the lagging indicators. The lagging indicators are actually what's happening in service inflation and what's happening in the housing market, right? The leading indicators are very, very clear. And you can see those very clearly by actually reading the earnings calls of businesses that are hiring people. Chipotle reports today after the closing bell. I highly encourage, if you are worried about the wage price spiral, listen to Chipotle. Chipotle reports tonight or this afternoon, and they are trying to hire 15,000 workers for burrito season. That's a lot of people, and it could create a lot of pressures in the labor market if other businesses do the same thing Chipotle is doing. But both Starbucks and Chipotle aren't seeing that wage inflation yet. We'll see what's confirmed in the earnings report from Chipotle later today. We also have Enphase later today, so there are a lot of things to pay attention to. But so far, I would say, while this wasn't like a FOMO pump of a speech from Jerome Powell, this was very clear that really this one strong labor report doesn't really make a difference. And if anything, he actually gave us more bullish information. This idea that the spread in the JOLTS report is probably just structural at this point, there are differences, and eventually we'll get to 2% over time. He didn't indicate that we had to get to 2% by a certain date. It's just, look, we're going to hold to 2%. We're not going to go for 3%. We're going to stick with 2%, and we're going to work in that direction. Now, of course, could there be black swans that happen? Absolutely. And what kind of black swans did he mention? Well, he made mention of potentially war being a black swan, war with China being a black swan, and he also talked about the debt ceiling basically being a debt swan or a black swan. And that's that essentially Jerome Powell would have no ability to shield markets from a crisis if the federal government did not pay their bills. And that ultimately there is no choice but Congress increasing the debt limit to ensure that we can pay our bills. That was made crystal clear by Jerome Powell. So there was no question at all that even with $31.4 billion of debt already outstanding, he says there's only one way this ends, and that is that Congress pays its bills. And if that doesn't happen, no one should think we can shield the economy or markets. Now, is this, what Jerome Powell said today, is this somehow, massively bullish to where it's like this big bat signal that to you says, buy, buy, buy? Absolutely not. Absolutely not. What happened today was just a reiteration that, look, we're starting to see some disinflation, but the process ain't over yet. Sure, leading indicators look good, but we've got to get through all the crap. So this is a game of patience, and I think it's one game that probably is won by owning shares, not in margin, and slowly increasing your exposure to pricing power style stocks. You want to increase your PP. It's very simple. Everybody wants a bigger PP in their life, and so do companies. And it's very important to make sure that you can look at companies, in my opinion, that have high free cash flow, positive net income, and in addition to that, ideally you want to find companies with positive operating leverage. Positive operating leverage are companies where if revenue is stable, their OPEX is going down. Or if revenues are growing, then their OPEX is growing at a slower rate than those revenues are growing. Things get concerning when you start seeing companies with increasingly negative operating leverage. That would be like revenues are falling and costs going up. That would be the worst case scenario. And unfortunately, you're seeing a lot of that with SaaS companies. And so I'm not the most bullish on SaaS companies for 2023. And I'd rather be investing in some of the more stick and shovel plays like chip equipment manufacturers, and actual durable style manufacturers, ones that have performed poorly in 2022, but I think are set up for increasing operating leverage here in 2023 as supply chains now reward those companies for refining their supply chains. That's my thesis. So again, is this somehow mega bullish? No, not at all. It's more punting is what it is. It's Jerome Powell putting on the hard face. Okay, look, we're going to acknowledge there's some progress, but we still got work to do. He's going to say that for the next 2 years. And maybe even beyond that. In fact, that's what he said in 2018 too. Hey, we still have work to do. It's the same story over and over again. So short of a quick trade, I don't think there is much here that has changed anything. And I'm going to continue looking forward to earnings and seeing where I could pick up some sweet deals. And if you want to learn more about some of the earnings I'm looking for or the trades that I'm planning for this month, make sure to join the courses linked down below on the programs on building your wealth. Join Elite Hustlers, Real Estate Zero to Millionaire, Stocks and Psychology of Money, you name it. And we'll see you in the next one. Thanks so much for being here, and we'll see y'all soon. Thank you. Goodbye.